Rob's Child here with another edition of Discussing Lessons Learned from Security Analysis by Benjamin Graham and David Dodd. This is video number 2. We're going to go over Part 1, Survey and Approach, Chapter 1, the scope and limitations of security analysis, the concept of intrinsic value. So this chapter reviews it reiterates a number of things that we talked about last time in the introduction. Once again, nothing I say here in any of this is advice. Buy the book. I'm not trying to replace this book. I'm trying to advertise it to you all so you can buy it yourself and read it along with me. And hopefully these videos can act as a supplement to reading this material. So I'm just going to dive right into it. So the first thing that he kind of goes over is how investment... Oh, sorry, I have these things in my ear. I don't need them. He discusses how investment is not an exact science. And he relates it to how law and in medicine or even in art, it's a similar thing. Analysis is not an exact science. There's medical discoveries that are made that take over old ones. It's not an exact science, but his main point with this is that analysis is still indispensable, is what he says. And so, and it may or may not apply to speculation. And he goes into that quite a bit. Next, in this chapter, he discusses the beginning of the Great Depression, the Great Crash of October 1929, and how what was going on in markets at that time was what he calls persistent imaginary values. I mentioned this in the first video, how I was saying how, no matter how much you think something is worth something in securities, no one knows how overvalued something can get, and no one knows how long something can remain undervalued. And I'm glad I said that in the other video, because I'm starting to feel more secure about that statement. It's a very central theme, it seems, of this whole book. He seems to reiterate that same idea over and over again in many different ways. So before the crash, there were persistent imaginary values, things just going up and up and up. None of it made any sense. You could bet against it all you wanted. You just lose, because at the end of the day, it's not a weighing machine, the markets. It's a voting machine. He mentions that specific statement later in the chapter as well. And then after the crash, the disappearing of real values. So something that has real value, and all of a sudden it's being sold for pennies on the dollar. And when that kind of thing happens, fortunes are made. When as I think Warren Buffett put it, buy when there's blood on the streets. I don't know if it was him. It might have been another one. You can correct me in the comments below if you're listening. All right. Moving on, I'm going to go through my notes on this chapter and talk about some of them. Another key takeaway I got moving on in this chapter was discussing bonds and preferred stock. Preferred stock, he's simply pointing out in this chapter, okay, it says it yields 6%. So if you don't know what preferred stock is, a lot of people listening to this video might not know what it is. It just means that if there's leftover money after paying all the debt and they want to distribute money to shareholders, the preferred shares get a preferred dividend, which means they get the money first. And once all of that has been satisfied up to that 6% amount of the face value, then it's offered to the common stockholders. So it's sort of a debt instrument, and it's not a debt instrument, though. It's just like you have the right to the first crumbs that fall off the table kind of a thing. But he was saying, like, why would you buy a preferred stock yielding 6% if it's not well covered by the earnings? If it's not consistently paying it out, it's like it loses a lot of value. So he just discusses that idea. And I wanted to mention too, yes, it's very important for people to understand. So many people and friends, and it's just the media, you only hear about the common stock. No one talks about preferred stock. No one talks about corporate bonds very much. But those areas, they're often ignored. They're areas where you can really make a killing. I have an investment strategy sort of speculation. Right now, as of June 12th, 2023, we have an inverted yield curve. I'm speculating that we will have a great devaluation in most securities pretty soon. And when that happens, I'm going to be buying a basket of high yield corporate bonds and preferred stocks myself, because those tend to reverse course the fastest. And I'm hoping that I can navigate my way through that and make. But anyway, that's the speculation. Graham would advise against what I do, but nonetheless, let's move on. All right, and he just mentions over and over again, prices can be wildly different than normal expectations. And he talks about, throughout the book, several specific examples that he's encountered. One in particular, he's talking about how a convertible preferred stock, so this is a preferred stock that's kind of like a guaranteed certain amount of the crumbs before anything can go to the common stockholders. It's convertible to regular stock at a certain amount. And so if the stock price goes up, the value of these preferred stocks goes up too. Because not only does it keep paying the dividends, it has that guaranteed dividend, it also, because it's convertible, has that natural rise to it. So I've heard about convertible preferred stocks before. I never equated in my brain how the common stock value going up can affect the value of the preferred stock. So that was helpful for me to read. And it makes me want to really seriously take a look at what the availability of preferred stock. I don't think I've ever gotten any direct preferred stock in anything. I've gotten into common stock of a lot of things. I'm holding a lot of common stock of a lot of things right now, but anyway, let's move on. He mentions that market price is often not related to intrinsic value. I guess at some point book value used to mean something, or does mean something more to certain people than others. But the book value, in other words, if a company were to sell all of their assets and they have a bunch of money and then they just divided that money up to the shareholders, how much money would each person get? That's the book value. So if it's 1, then and your share price is $20 and the whole company liquidated, you should get $20 for that stock. That's in theory how that's supposed to work. So book value, I always check book value of stocks myself, and it's important, but market prices often don't relate at all, especially in this bubble coming out of the COVID pandemic, book values, I mean, it's still right now, book values of many companies that are earning money, that have gotten just totally out of hand. A book value of 1 is attractive. Less than 1, more attractive. But it combines with a lot of other things. I mean, that's the point of this book is to understand how all these things kind of fit together. Moving on, I'm going to try to get through this as quickly as possible. I have a few pages of notes here. So he talks about earnings and how if you're not familiar with price earnings ratio, the PE ratio, click pause and look it up, look into it on Investopedia so you understand what that means. He talks about it in terms of if you have a company that has earnings that kind of bounce all over the place, 1 year they're way up, 1 year they're way down, it kind of it doesn't help you give an intrinsic value. So even though you see a company that says it has a PE ratio of 8 or 209, if you look at its history and it's been way up, way down, and all over the place, then it doesn't really help you determine what the value of the stock should be, because you don't know what the future is going to be just by that metric alone. So, he's just basically saying earnings have their limitations, especially if they're not consistent, is the main purpose there. So that's an important lesson to learn, I think, because I often am looking at the PE ratio of companies and I'm not thinking about that. I'm not thinking about, well, what about for the past 10 years? Has it been consistently up, 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 up? Has it been like a staircase? Is this a dependable metric that I can be using to determine the value of this stock or not? So that's a helpful point, I think. So from that metric alone, it's guesswork. You do have to take a look at the history of at least at the history of the earnings to get a decent idea of intrinsic value. So with that said, intrinsic value, assuming you have all those ducks in a row, he talks about, he gives a quote. I'm not going to say quote. He gives a scenario here of how to understand earnings. So he relates it to if a woman is old enough to vote, you can look at her face and you can get a general idea, or if someone is overweight, if someone's, this is how we should see intrinsic value coming from earnings. There's a certain range that is within the definition of what we define it. So even though you might not know the exact weight of someone that's overweight, you can clearly see very easily if someone is clearly overweight or not. And this is a way that we should kind of use that in terms of discovering value of securities. He mentions there can be a big range, right? So like the weight of a person, you can have someone of my height, 5'7", is supposedly a healthy weight between, I think it's 128 all the way up to 159. That's a big range, similar to what's normal of the price of a security compared to its earnings. But when you're outside of that range is when things get interesting, right? So if I was 110 pounds and you can see bones sticking out of me, it's like, oh, that guy needs some food. And if a stock looks like that, it might be something to scoop up. And if something is like so fat that it needs a wheelchair, and I'm sorry if I'm offending anybody, but it's like, okay, maybe we can short that. Maybe we can, or at least sell it if we own it, right? If something's overweight or underweight. Again, I don't mean any offense in those terms. But that it comes from his example, and this was written in this edition's from 1940, just to give you an idea. The whole woman voting age thing too. It's his examples are perhaps a little less PC than what we're used to today. But anyway, let's move on. So when things are outside of the normal range and it becomes obvious, that can present an opportunity. And that's the point of that whole thing. And then he goes on into another section where sometimes opportunities can be so great that you end up with an arbitrage situation. Again, if you don't know what arbitrage is, look it up. Any of these terms, look it up. But he says, he doesn't like going into that because it's outside of the realm of serious security analysis. Yes, there are great arbitrage opportunities out there, and Warren Buffett took huge advantage of one with Blizzard and Microsoft recently. He's like, this is easy. It's free money when you have certain situations come up. But anyway, he says they're rare and they're not part of this, not part of security analysis. But he's certainly not saying, don't take advantage of things like that. But anyway, I digress. So, all right. So then he goes on to a section talking about the 3 obstacles of an analyst. The first one, bad data exists. Now, as someone living in 2023, we have seen a lot of bad data exist. One big one that comes to mind, I believe it was Enron, I think, that had, so we've had companies that just straight up lie. Some of these Chinese companies, getting audited and clearly just straight out lying about what's going on financially with the companies. Bad stuff. And it's a big obstacle of any analyst. You have numbers that they're presenting. You have information that a company is putting out, and even in here he says, "Oh, well, everything's going to be okay now because there's SEC laws." Well, welcome to 2023. It hasn't changed a whole lot. There is lots of very bad information out there. A lot of the way balance sheets are even calculated, they can be done in different ways to sort of show a different picture of the company at different times, depending on what the company wants to present. I mean, these things exist; they're real. So that's one big obstacle of analyzing any kind of security. Second thing, uncertainties, conditions of the general environment. Right now, we have an inverted yield curve. There's a lot of crazy stuff going on. We are in uncertain times right now. Unemployment is low. That creates a feeling of stability to some degree, but inflation's very high. The Fed's raising rates. The yield curve is inverted. There's a lot of uncertainty going on right now too, economically. So then the past of a company, so their previous earnings, or the past of what's been going on. He says using uncertainties is best for analyzing senior securities. In other words, bonds, corporate bonds, and preferred stocks. So you want to take into consideration these securities that have stable payments, that are guaranteed. I know what the money flow is every year, and then all of a sudden we have uncertainty going on. That's going to affect senior securities, perhaps more than junior securities, I guess we can call them, like common stocks and stuff like that. And then the other big obstacle is an irrational market, and that happens just over and over and over again. You have companies trading for valuations that are just so unbelievably speculative, but no one knows how high that can go. It's a voting machine, not a weighing machine. We'll get back to that idea again soon. So I wanted to do a quote. If you have the second edition, the same book that I have from McGraw-Hill, it's on page 25 towards the bottom. I have a quote here I wanted to share. It says, "Owners of securities, whatever their character, are interested in their market quotations." Oh, yeah. So the reason I wanted to quote that was because I think it's funny. I hear Warren Buffett oftentimes saying, "We don't care about price." Baloney. I don't care about price. It's a fancy idea. It's a nice idea. Like, oh yeah, I like Coca-Cola stock, even if it's only going to pay me a penny a year, and it's $1,000 a share. Like, it's still a good company, so I'm going to buy it. No, that's nonsense. He's pointing out the hypocriticalness of people that say that. The marketability of the securities that you have matters. It does matter. It matters a lot. And no one is immune to that. You do have to consider that. It's funny to hear Warren Buffett say that, but then he'll be buying and shorting things based on what he considers to be the fair value. It's baloney that he said. He's full of a lot of baloney. The more I think about Warren Buffett, I'll bring him up again later. By the way, this guy, he's your friendly neighborhood grandpa that just wants to give everybody a icy drink and be your friend. No, he's ruthless, and he's a liar. I'm gonna talk. I will probably talk about him more. By the way, the more I get into this book, I'm not even that far into this thing, and I'm starting to just realize these kinds of things. Anyway, I digress. Let's move on. Let's stick to the subject. So the quote, yeah. So even in bonds, the purchaser, he says, I quote, "The purchaser is supposed to pay no attention to market fluctuations, but just continue to see if it's a sound investment or not, if it can continue paying the payments, the interest on the bond." But no, the price of the bond matters. The marketability of it matters. How well you can sell that bond while there's still however many years left. It does, in fact, matter. Okay, we're going to go on to the next topic. Now we get to common stock being out of line with its true value, is what I wrote. All right, let's move on. There's a section, this is the section where, after that part, where he talks about how, again, so you never know how long something can remain. If you think something's crazily undervalued, nobody cares. It can stay undervalued until it's undervalued. So, until it loses value, right? So if you think something's undervalued, it can stay undervalued for longer than you're comfortable with. It can potentially never get to a fair price, even though you think that it should be a higher price. And then things can change, and the value can change. The value can change drastically, and it can have nothing to do with the market price. As I've mentioned before in the last video, one of my favorite recent examples of stocks is this Starbulk dry shipping company. If you had bought it at its bottom and got the subsequent dividends, it would have paid for the stock. You'd have the stock for free, and you would have gotten all the money back in cash that you paid for it over the course of like a year or two. It was like ridiculous. So, and now it's back down, and anyway. Yeah, so valuations can be really wild out there. Really wild. All right. Next area, I have another quote from page 26 that says, emphasis on the discovery of undervalued securities when business and market conditions are on a fairly even keel and proceeding with greater caution in times of abnormal stress and uncertainty. So he's mostly talking about as someone that is trying to understand value of a certain security. If there's times of abnormal stress and uncertainty, you have to have greater caution, and that makes sense. It's better to find something that's undervalued, that's making the clear, consistent, positive, growing earnings in a normal environment than it is during something crazy going on. Like right now, it's harder with the inverted yield curve. For example, I'm going to move on. And this is, after that quote on page 26, he says on page 27 specifically how markets are not a weighing machine. What he means by that is the value of securities doesn't and will it can. Okay, so it can sometimes weigh things properly, but it doesn't. That's not the kind of machine it is. The markets are a voting machine. We vote how much something costs. It reminds me of the MIT course that's free on YouTube, how he has people bid up a box with an unknown thing in it to a certain price, and it's a vote, until it goes around. Everybody's like, oh, I'll buy it for that much. Oh, I'll buy it for more. Oh, you'll buy it for that much. I'll buy it for even more. It's a voting machine. Even if we have no idea what's in the box, people pay for it. That's how these securities kind of work. Okay, so, and then there's a chart on page 27 which relates market factors and future value factors as contributing to speculation. However, future value factors combined with intrinsic value factors contributing to investment. And one of the goals of value investing, one of the goals of this book is value investing and sound investment, because anyone can speculate anything going to the moon or going down to nothing. But if you want to put things in your favor, you want to have a good investment policy, right? It's a joke because that's the intro is all about the problems of investment policy. But how can you invest? How can you make good decisions and reduce your speculativeness in markets? So, and then he mentions a study that was done on cheap versus dear stocks. In other words, stocks that were held in high esteem and worth relative to their earnings much more, the performance of the value of those stocks versus stocks that are considered to be cheap or undervalued, which ones perform better over time. He says the study, according to this chart in the appendix, is inconclusive. So it just kind of is the last nail in the coffin of the idea that just because you buy something that everybody likes, or just because you buy something because you think it's cheap, it doesn't give you an advantage. That's not where the advantages are. I thought that was a very interesting idea. All right. We're almost at the end of my notes here. You bear with me. So with that, even great analysis is hazardous because there are no guarantees. My key takeaway I'm going to coin as my own phrase is no one knows how overvalued something can get, and no one knows how long something can stay undervalued. That's probably the biggest risk out there. He also says, so analysis serves you better for investment than it does for speculation, and it's not supposed to guide you, it's supposed to support you. So it can support, I say here, he supports speculation but doesn't guide the speculation that you kind of have. So these words are used in different ways and sometimes in different areas. I'm very sorry if any of this is convincing. I'm trying to hold it together as best I can. Again, read the book, hoping some of my comments might open a discussion in the comment section, or give you some more insights, or give me more insights if with any responses to any of these videos. So I wanted to end with a quote, another last quote, page 30, the very last part that I really liked. He states, on these matters of varied import, security analysis may be competent. Security analysis may be competent to express critical judgments, looking to the avoidance of mistakes, to the correction of abuses, and to the better protection of those owning bonds or stocks. And what he refers to, or also often in this book, how you have to understand this is when we're analyzing securities, we're doing it with the purpose of trying to determine if this is something we should buy, something we should sell, or something that we should hold on to. Those are really the three moves that we can make when it comes to owning, selling, or holding securities. And with that, security analysis. I hope you enjoyed this edition, and I'll see you next time. Rob's Child.